Thank you so much for having us today. I'm excited to present this paper with my colleague Niels, who's also at the Booth School of Business. Let me see if I pass the test of the clicker. There we go. So this paper is about how firms perceive their cost of capital and why it can matter for the real economy. So as we all know, in standard models and standard teaching, standard theory, we typically think that firms intuitively invest into projects when the expected return to the project exceeds the cost of capital of the project. Now in practice, firms often think at the firm level, so they tend to think about what's our firm level cost of capital and use that as a starting point to then figure out which projects do we take or not. Now the majority of firms actually just operate with a firm level cost of capital and tend to evaluate projects against that. A few firms do price in the risk of individual projects, but again, they often use the firm level cost of capital as a starting point and then revise upward or downward depending on what they think the risk difference to the individual project is. So today we're going to be thinking a lot about the individual firm level cost of capital. And again, in standard models and standard teaching, we tell firms if you want to maximize your market value, what should you do? You should set your firm level cost of capital equal to an expected return, in particular the average expected return in financial markets to the outstanding debt and equity of the firm, the weighted average cost of capital. Now that sounds pretty easy in principle, but there's a big problem, of course. That expected return is very hard to estimate, it's unobserved, and so firms have to come up with some way to set a perceived cost of capital, figure out what do we think is the right cost of capital that we should use. And that's the object we're going to study today. Why do we think it matters? Well, first of all, the assumption that firms do what we teach them is pretty baked into many of our standard models. So bedrock assumption of most finance models, macro, IO, I could go on, is that the perceived cost of capital that firms themselves set is equal to an expected return to the weighted average cost of capital. But beyond the academic interest, we'll show you later that the perceived cost of capital actually shapes the long-run allocation of capital across firms, and so has some pretty strong relevance for which firms invest, which firms allocate, get capital, and ultimately what's the productivity in the economy. There's also some introspection here. All of us probably spend time talking to MBA students and managers about the cost of capital. Do they listen to us? What do they actually do when they go out there? We'll try and sort of think about that in this paper today. We know a little bit about what firms do from surveys, but those surveys tend to be more qualitative. So we know, for example, that many firms use the CAPM, but on top of that, about 70% of firms in surveys say they use other multi-factor models, whatever they may be, and 40% say they also consider past returns. So overall, we don't really have a clear picture quantitatively of what is that perceived cost of capital and how does it matter in the real economy. What will we do today? So first of all, I just want to explain to you how we can measure that perceived cost of capital. We'll use corporate conference calls to try and extract what the numbers are that firms set for themselves. We'll then think about two levels of variation. One will be time variation. So to what extent do changes in proxies for expected returns in financial markets actually change the perceived cost of capital of firms? And their firms seem to be doing relatively well relative to what we teach them. So on average, they do seem to adjust their perceived cost of capital when interest rates or expected stock returns move. But the picture is quite different once we get to cross-sectional variation. So we'll use an asset pricing technique to decompose the perceived cost of capital into a component that's justified by true expected returns and a component that's not. And we'll find that about 20% of the variation is justified, but a whopping 80% is not justified by expected returns. Now that number is a bit better for the CAPM model, so about 50% of variation of the perceived cost of capital can be justified by the CAPM, but there's still quite a lot of excess dispersion. Another way to think about those results is that firms are using systematically biased measures of the perceived cost of capital, biased relative to what expected returns are, biased relative to what the CAPM suggests they should use. And then finally, we'll write down a simple model, inspired by the simple misallocation model, and we'll say that through the lens of this model, it looks like that the deviations that firms are introducing between the perceived cost of capital and expected returns can lower TFP by quite a lot because the wrong firms are getting more capital. And we'll think a little bit about what that means. One implication you could draw is, well, there's huge welfare losses, and we should think about what firms are actually doing to improve the allocation of capital. Another interpretation is that the standard model is completely wrong about what firms are maximizing, and we should try and understand how can we rationalize firm behavior better. Okay, let me get into the data to start. So as I said, we'll use corporate conference calls. And on conference calls, you often find these kind of statements, where the manager says our weighted average cost of capital for the company is a given number. And our approach is to manually go through all the conference calls available on the databases FactSet and Refinitiv and read paragraphs that contain a keyword related to capital budgeting or the cost of capital. And we'll extract all those numbers that we think are relevant. We'll do that within our A team, have multiple rounds. And the idea is basically to collect all the numbers that apply to capital budgeting. We'll collect the cost of capital. They also sometimes talk about the cost of equity or the cost of debt that they perceive. We'll record required returns like hurdle rates, or sometimes they're called discount rates, and realized returns as well. And we're doing that to make sure that we're not confusing concepts, but we're sort of delineating clearly between what is the cost of capital and what are other numbers that they're talking about. Now again, we'll talk about the firm-level cost of capital today. Some companies also give project-specific numbers. We record them differently, but they're not really going to be the point of the analysis today. What do we have? We have about 30 to 100 observations of the perceived cost of capital for 1,200 firms in 20 countries. These firms, on average, look like other listed firms, except they tend to be much larger. Now, I won't go into details. We have quite a bit of analysis of sort of representativeness in the paper, but basically the idea is that the firms that we see are larger, but that whether they report is not predicted by standard financial variables like leverage, like their investment ratios, and so on. Now, the sample is highly unbalanced, so we don't observe every firm in every year over this period. But if you add up the assets of all the firms that we observe once, you cover about 40% of the listed assets in CompuStat, so a relatively large sample. Our main analysis is going to be cross-sectional, so that's kind of the sample coverage that you want to think about. We have more information on the data and some downloadable data on the website as well, in case there's anyone who wants to play around with it. Now, I want to emphasize that these data are verifiable. So we have the CEO or the CFO of some of the largest listed corporations on tape telling us what they think their cost of capital is, or what the hurdle rate or required return that they use in investment decisions is. These calls get used sometimes in security lawsuits, so we don't think managers can lie on them, and we think they take them somewhat seriously in trying to convey to investors what they're actually doing. And again, we have some data validation in the paper in more detail that suggests, for example, when firms change the hurdle rate or the required return they give on these calls, they do actually follow suit in their real investment decisions. I have a bit more validation on real outcomes later for you as well. So let's, just to make sure everyone's on the same page, let's think about how the perceived cost of capital can actually matter for investment and capital allocation. So the way firms work is that they set a hurdle rate or a discount rate, the minimum required return that they want to earn on new investment projects. And that is based on the cost of capital, but there's also a wedge that I call kappa on this slide. Now, in the short run, it turns out that short-run changes in the cost of capital have very little impact on these hurdle rates. But in the long run, they do get incorporated. And one way to see this is this picture. So this picture plots the coefficient from regressing a change in the hurdle rate on a change in the perceived cost of capital. If you look at observations that lie within 2 years of each other, you basically find a zero coefficient. A 1 percentage point change in the perceived cost of capital has no effect on the hurdle rate within 1 or 2 years. But if you look at the long run, it seems like that wedge becomes smaller over time, and firms do include persistent variation in their perceived cost of capital into their discount rates. And so basically, if you think about short-run variation, you want to think about the hurdle rate, but in the long run, the cost of capital is quite important. I'm going the wrong way. Now, the survey evidence on this question has been mixed. In fact, if you compare the raw averages from surveys, sort of how does the raw average survey cost of capital relate to the raw average discount rate in the 80s versus 2020s, that actually implies full incorporation. And I think the fact that it goes up over time suggests that these surveys probably are quite informative about long-run relationships, but maybe not so informative about the short-run disconnect. Now, this picture raises a number of questions. And I just want to take a step back before I get into the analysis of this paper to tell you, what we've been thinking about here. So the first question that you may ask is, well, this kappa that we've talked about clearly varies over time. So the wedge between the hurdle rate and the cost of capital is very big in the short run, but then tends to go down if the change in the cost of capital is persistent. So these time-varying wedges will have time-varying distortions to investment. And we think about those very carefully in the paper that we've just sort of nearly completed. And we show that, in fact, the fact that US investment has been so low since 2000 relative to what we think it should have been can be accounted for by the fact that there's this big distortion between how firms actually think about the investment hurdle rate versus what financial markets price in through the cost of capital. There's also policy implications. If you think about conventional monetary policy, that becomes much weaker because an interest rate shock doesn't affect the hurdle rate in the short run. But other shocks like fiscal policy and expected inflation become more powerful, and so we think about how those tools can be used by policymakers in another paper. Now, another question is, why are firms doing this? I've told you about the facts, but what's going on, and there's a lot of work. I'm just giving you a few slides from sort of the last calendar year on what may be driving this. Governance, behavioral, financing frictions. I think there's a lot of interesting work happening, and sort of excited to see where that goes and whether we can empirically reject or confirm some of these models. But today, it's all about the long run. So it's about how do firms think about long-run capital allocation, which firms invest and do not invest in the long run. And that, as that picture suggests, depends on the perceived cost of capital. And so we want to understand, where does that come from, and to what extent does that line up with what we think it should do? Now, one more piece of empirical validation that's, I think, useful here is that, in theory, if you think the perceived cost of capital actually does influence how firms invest, you would expect that firms with a higher cost of capital invest less, have higher average realized returns, and use less capital relative to other inputs. And that's exactly what we find in the data. You can see that on the x-axis are bins for the cost of capital. The average return on the real capital invested by the firms is higher for the firms with a higher cost of capital. They invest less, that's the middle picture, and they use less capital relative to labor. And those are not just random plots. It turns actually out the magnitudes predicted in those figures are pretty consistent with a basic Q model calibrated with some sort of modest adjustment costs. So we think that's sort of reassuring that what we're measuring on these calls actually is reflected in the long-run capital allocation decisions of these firms. Let's start with some time variation. What goes into the perceived cost of capital? So here we're just plotting simple plots, two very simple proxies of expected return measures. On the debt side, we're just looking at changes in time of the treasury yield. On the equity side, we're looking at changes in time of the earnings yield. And you can see that the perceived cost of capital does seem to move with the earnings yield, and it does also, the perceived cost of debt, which we record separately, does seem to move with the long-run treasury yield. So it looks like the big trends over time are being incorporated by these firms. And in fact, if you read these calls, these firms think carefully about what their cost of capital is. Many of them actually give us the models that they use, so they're somewhat paying attention in class to what they're being taught. So that's maybe reassuring for us teachers. Now, you may also wonder about what's happening with some of the classic factors. So here we're thinking about leverage, beta, size, and value. And you, again, see correlations that are consistent with the basic intuition that we would expect, or the basic results that we get out of asset pricing models. So firms with more leverage have a lower cost of capital, higher beta, higher cost of capital, size, lower cost of capital, and value, slightly higher cost of capital. And that's, of course, consistent with Modigliani-Miller for the leverage result and Farmer and French for the three factors. So classic factors seem to go in there, and time variation seems to line up as well. The data are useful because they also allow you to look at some dynamic variation. So we're looking in a separate paper, what's happened to the cost of capital of green and brown firms. I just want to flag this quickly here that because we have data in regular intervals, we can actually look at changes over time, and it looks like since 2016, since the boost in sustainable investing and sort of more regulation by governments in this area, the green cost of capital, the cost of capital perceived by green firms, has gone down by quite a lot more than the cost of capital of brown firms, and there's some interesting implications for what that means for the allocation of capital to green investments and potentially the green transformation, and we think about that in this other paper. Okay, but the main point of today is how do firms set their perceived cost of capital relative to what expected return measures would suggest they should do? So now we want to test that particular prediction that we always hard bake into our classic models. Ideally, what we'd like to estimate is the relation between the expected return, the true expected return in financial markets, and the perceived cost of capital. Now, if we could run that regression, we could directly test whether firms immediately use the expected return as their perceived cost of capital if the beta were 1 and the R squared is 1. So beta 1 means the perceived cost of capital is unbiased. R squared 1 means they literally use the expected return as their perceived cost of capital. But we can't do that, of course. And that's the classic problem in much of finance. We can't observe the true expected returns. So here we're going to use kind of an asset pricing trick where you can use realized returns, which are equal by definition to an expected return plus an error. And then we can just estimate the realized on the perceived. And by definition, the B1 that you estimate there is going to be equal to the beta 1. And I don't want to take credit for this. This goes back to John Campbell. But we're just applying it here in the context of thinking about the perceived cost of capital as a particular type of return. And what do we find? Well, if the perceived cost of capital is an unbiased estimate of the expected return. And by the way, that's a weaker condition than what we bake into our models. There we say it should always be equal. Here we're just saying, is it unbiased? That beta should be 1. It turns out that when we're using realized returns, so this is using 3-year forward-looking returns, you can also do 5-year or longer horizons, you get pretty far from 1. In fact, you're closer to 0 than to 1. So that rejects that the perceived cost of capital is equal to the expected return, because it's not even an unbiased estimate of the expected return. Now, you may think, well, they don't think about expected returns. They think about what we often tell them in class, the CAPM. So what we do is we can also repeat this analysis for other types of measures of what we think are proxies for the expected return, like the CAPM-based cost of capital or a French 3-factor model-based cost of capital. And you see the CAPM model does a little bit better in the sense the coefficient is closer to 1, suggesting that firms maybe do target the CAPM. But it's also still pretty biased in the sense that it's only 0.5, so 50% less than it should be, 50% away from 1. Now, note that if firms really use the CAPM, we're already having quite a big break here from the standard model, because in the standard model, they should be using expected returns, not the CAPM, to maximize market value. So if they do use the CAPM, they're sort of not explicitly maximizing market value. But again, that's just sort of an implication of this, but it also turns out not to be true. So intuitively, one story that emerges here, and that's sort of consistent with the data, is that firms seem to start with a CAPM, but then they add other stuff, and that other stuff actually takes them away from the true expected return. And in fact, they also add other stuff to the CAPM that doesn't really help get them closer. Okay, so far I've talked about the beta 1 as kind of a measure of bias, but you can show algebraically that another interpretation of this beta 1, in fact, interpretation of 1 minus the beta 1, is that you can call it the percent of the variation in the perceived cost of capital that's not justified by any variation in the expected return, or like the CAPM or whatever you want to use on the left-hand side. So we call that excess dispersion. It's sort of this idea that there's more variation in the cost of capital than is there in the true expected returns or suggested by the CAPM model. And that'll be useful later, because many of the misallocation models explicitly look for that kind of variation. They look for to what extent is there variation in the marginal price of capital of firms that's not justified by expected returns or other types of financial returns. Okay, so if you're not yet convinced by the realized returns, we can also use another measure, which is the implied cost of capital. That's sort of an accounting-based measure that relies heavily on analyst forecasts, and some people think that's a better estimate of expected returns than, say, the CAPM. So we try that as well. So you need an assumption for that, and specifically the assumption is that the implied cost of capital depends on the true expected return plus an error, where the error is uncorrelated with the perceived cost of capital. Now, if that is true, you can just run those regressions. Now, the implied cost of capital doesn't have a lot of noise in it because it's not based on realized returns. So the standard errors are smaller, but the point estimates that you get are pretty similar. Excess dispersion is large, pretty close to 1, and suggests that, roughly speaking, sort of 80% of the variation in the perceived cost of capital is not justified by the implied cost of capital or expected returns or other types of financial measures. Okay. Nothing is happening. There we go. So we look at heterogeneity, which kind of firms seem to incorporate more excess dispersion. There's some evidence that maybe the smaller firms have more excess dispersion, but in general, there's not a sort of really striking dimension of heterogeneity that flies in your face. So most firm types seem to introduce a lot of excess dispersion and so basically have biased measures of the perceived cost of capital relative to expected returns. So we observe separately the cost of debt and cost of equity. So we can ask to what extent this is driven by perceptions of the cost of equity and the cost of debt. And you see that almost everything is driven by the cost of equity. And I think that makes a lot of sense, because the cost of debt is somewhat easier to calculate. You see there's hardly any excess dispersion in the perceived cost of debt, but there's a lot of excess dispersion in the perceived cost of capital. This finding is also useful when thinking about how reliable are our data, because it suggests that it's not just noise, right? So the part that's relatively easy to predict is actually also reflected in manager predictions. But the part that's really hard to get right, the expected return on equity, seems to be pretty off in managers' expectation. We think more about measurement error. I think the most striking fact beyond this, that error isn't driving our results, is that the perceived cost of capital actually predicts investment. So it's consistent with investment. We also think about a factor-based IV test. And in general, we're sort of somewhat comfortable saying that we don't think measurement error in the perceived cost of capital drives these results. So this was sort of fancy econometrics, but you can do something much simpler, okay? Just look at the dispersion in the perceived cost of capital and the perceived cost of equity, and then ask yourself, is that reflected in what we typically think differences in expected returns in financial markets are? So the 10 to 90 spread on the perceived cost of equity is 8%. It's pretty hard to find stocks that have 8% differences in long-run expected returns. So just that picture already tells you that probably something is going on in these estimates that diverges from what we typically think expected returns are. So let's take this a step further and let's ask ourselves, how much can this matter for the real economy? So we've shown you that the perceived cost of capital is associated with capital allocation by firms. And now we want to gauge how much can the perceived cost of capital explain in terms of dispersion in TFP and TFP losses in the real economy. So in standard models, the logic is simple. If firms don't use the expected return as the perceived cost of capital, then the wrong firms are getting capital. Some firms are getting too much, some firms are getting too little capital. And that implies a TFP loss. And our discussants have done some really cool work in this area, thinking about to what extent can we incorporate risk premium and other types of heterogeneity in these analyses. We're going to keep it quite simple. We're going to use maybe the benchmark model in this literature, Shea-Klenow, and that model predicts that the TFP loss coming from errors, or from, then we may call it deviations in the perceived cost of capital relative to the expected return, is directly proportional to the excess dispersion that we can actually measure in the data. You need some assumptions, as you always do, and this is sort of the most basic way of getting at this. And you can obviously add a lot more into it, but that's just sort of the starting point. And you find relatively large numbers, so that the TFP loss is about 5%, given the distribution of perceived cost of capital we observe relative to what it should be, given expected return. So these are big numbers. And there's two implications. One implication could be that really what firms are doing causes huge welfare losses. That sort of sounds sad at first, but let's be glass half full. It means that teaching corporate finance can really make a difference here, right? If we sort this out, we're increasing TFP by 5%, that means increasing GDP by 5%. I take a 5% cut of this for all of us, that would make the finance profession very happy and the world very happy. There's another explanation, which is that actually what firms are doing is extremely efficient, just our standard models are completely wrong. Firms are not maximizing market value, they have different objective functions, and that means, again, a lot of work for corporate finance and asset pricing theorists, trying to figure out what's going on, what the firms are actually doing. How can we rewrite the standard models to have a predictable way of what firms are actually maximizing and how they're setting their cost of capital. So we think a little bit toward the end of the paper about what could be going on. One story is the one I alluded to previously. The expected return is hard to estimate. Firms start with a CAPM, they get that's too simplistic, and then they just smack on some wedges, and those wedges are just completely wrong. And they can take them far, far away from what the true expected return is. That's consistent with the data. Another model that you might think about is, well, maybe firms just have a different explicit objective than maximizing market value. Maybe they want to maximize market value 10 years from now. Maybe. It turns out you get a lot of excess dispersion no matter what timing you sort of test in the data. You can test forward-looking returns, starting T+1, T+3, whatever it is, they're far off relative to that. Well, maybe firms have a completely different model. They think equity prices are completely wrong, okay, kind of Jeremy Stein style. We don't want to pay attention to stock markets at all. We're going to make up our own weighted discount. We know what the fair value is, and maybe that fair value is the CAPM. Well, if that's true, they're still getting it wrong by 50%. That's an interesting angle, but I think to really nail that, we want a formal model of what our firm's actually saying rather than just saying, oh, they're doing something different. They think markets are stupid, so they're doing something different. But to model it, to make policy based on that, we need actually a model of that. Now, it could also be that firms actually don't know what the true model is, right? So everything that I've talked about sort of assumes a full information rational expectations model, where firms know the model and they learn from the model. And in that cases, they should get it right. There should be no bias. But maybe firms don't know the model. Martin and Nagel and lots of other people have thought about these types of problems. In some extreme cases, you can get excess dispersion if agents are Bayesian learners. I've not seen a model that gives me 80% excess dispersion. You need a lot of excess dispersion, and you need Bayesians that don't shrink a lot. And that's actually not true in many standard models. But again, there's potential here, and maybe we can think about that. Finally, what I don't think is going on is I don't think firms are sort of signaling some fake value of the cost of capital on the calls. Why? Well, first of all, if you want to signal a low cost of capital, you want to lose a lower number than what the expected return is. In fact, it turns out firms are giving much higher numbers on average than what we think basic proxies for the expected returns are. Moreover, firms are actually using these numbers. I've shown you the data. The perceived cost of capital predicts investment. So that'd be a pretty costly signaling thing to do. And then perhaps most convincingly, if you think about which firms are desperate to signal a low cost of capital or signal low risk, those are distressed firms, undervalued firms, firms that are not making a lot of money. These firms don't actually have more excess dispersion. It's not like they make more mistakes. So in that sense, I'm sort of confident that it's unlikely to be signaling. But there's interesting work to be done here, sort of trying to figure out what are the other three alternatives, which ones are most convincing. Okay, so here's the conclusion. Across the board, the perceived cost of capital deviates from the expected returns. Firms don't do what we teach them in our basic classes and don't do what we assume in our basic models. And I think there's interesting implications for both research and for practice. So of course, for research, if you're writing down a model where the perceived cost of capital that firms use is equal to the expected return, that's a hard assumption to sort of maintain given what I've just showed you. We get TFP losses in our standard models, so maybe either we have really a welfare problem here that we can solve, but otherwise maybe we want to think about how can we rationalize what firms are doing, and those are the three options that I showed you on the previous slide. But there are also implications for practice. I mean, we go out and teach our students the CAPM all the time, and then we go home and crack up about how stupid the CAPM is, and these guys are actually using this. It really matters. I think there's maybe some interesting questions to be asked about what are we teaching firms about how they should set their cost of capital? Should we do things differently? Should government policy maybe even think about targeting the TFP loss? Lots of questions, some answers in this paper. There's more on the website, more on the data. And if you do end up using the data, please let us know. It's all work in progress, and we'd love to talk about it. Thank you so much.